Published 17/16 the 16th of December 2017. Updated 17/16 the 16th of December 2017. Insurance giant Aviva is facing open-ended losses that may in theory run to billions of pounds thanks to a bizarre investment product sold in the pre-internet 1980s that lets its owners profit from moves in financial markets after they have happened. It is pitting the FTSE 100 firm against a 28-year-old Frenchman, MaxHerve George, who lives in the Swiss ski resort of Gstaad. He says Aviva, which looks after pensions for millions of Britons and has many UK private investors, could owe him more than €1 billion over his lifetime. Challenger MaxHerve George, who lives in the Swiss ski resort of Gstaad, Aviva says his claims are utter fantasy. It insists the risks posed by these known price arbitrage contracts are limited and that it has already disclosed the potential liabilities in the accounts of its French business. The row has rumbled through the French courts for 15 years, but it is only under a ruling earlier this year that George has been able to start benefiting from his investment. He says Aviva has had to credit him with up to €500,000 in some weeks and that since January he has made millions of euros in profit. Thousands of the known price contracts were issued by French firm Aviva in the 1980s to attract wealthy customers. In 2002, Aviva became part of Aviva France, owned by Aviva plc. Under the contract's terms, every week holders can switch their money between different funds spread across the world in sectors ranging from equities to gold. These have become known as golden tickets because they allow holders to invest each week with 20/20 hindsight. They can look for an investment that has gone up over the past few days and buy it at the price listed 7 days earlier. The contracts are a throwback to the days when transactions were all on paper. Prices of some investment funds were published less frequently and it could take days to complete a trade. The advent of the internet and instant pricing has made it relatively easy for holders to profit. Then Aviva persuaded many holders to amend their contracts in return for smallish sums. Others refused, including George, who sued Aviva France over his contract, bought for him by his father. George, who runs a business in Geneva developing luxury hotels, told the Mail on Sunday, "Last week, I made 1.68% on my portfolio. The week before I made 1.5%, in some weeks he had made 5%. Since January, I have made millions of euros." One actuary believes George's contract alone could cost Aviva at least €1.22 billion over his lifetime, and if the firm is forced to expand the range of investments covered, the cost could even hit €5 billion. Aviva is appealing to the French Supreme Court. But George's London lawyer, Véronique Favreau, said, "The only thing at stake now is the level of damages Max is owed because of Aviva's previous refusal to honor the contract." Aviva says MaxHerve George claims are utter fantasy. His Paris lawyer Nicolas Lecoq-Wallon said he has about 50 clients also suing Aviva, some of whose holdings are as large as George's. One is Didier Cartreau, an insurance broker. He said, "Other companies issued these contracts. But instead of fighting their customers in court, they settled them, and paid them off. That was expensive. But only Aviva has behaved in this way, and it may cost them far more." An Aviva spokesman said, "The numbers being quoted are utter fantasy. Aviva France is appropriately provisioned, its reserves are audited and reviewed annually. This matter is subject to litigation and Aviva will not comment on the specifics of the individual case."